this is how much I need to keep at least. How do I make that gift? Who do I make it to, and when? Those are the next questions. And that's, particularly with children in their 20s, you've got various different factors that come into play. Do you want to make a gift to them directly when they're just starting out in their careers? What would that do to their own ambitions and potential drive to become an entrepreneur in their own right, for example? Is it too much too soon?
And then there's probably quite a large chunk for Richard and his family that he's going to pass on. He's not likely to need in his lifetime, and really that can have a longer term time horizon, and that is where you can go for growth, probably full equity exposure, and you can still receive the income from it, but ideally you're looking to reinvest the income and let it compound for his children, grandchildren, and set up a multi-generational sort of opportunity for his family.
Today we're discussing the case study of a 62-year-old business owner in the UK considering his options around a business sale. I'm going to set up the case study in a moment, but first I'm going to come to my two guests for a brief introduction on what they do, starting with you, Chris.
Thanks, David. So my name's Chris Etherington. I'm a private client partner at RSM, the accountancy firm. So I specialise in providing personal business tax advice to primarily business owners, entrepreneurs, their families and related structures.
Great to have you with us. And Tom?
Thank you, David. Tom Vernon, Sarasin Partners, Head of Private Clients. Predominantly we look after individuals, families and charities, looking after their wealth, making it last, helping them through just this sort of situation.
Great to have you with us. I'm going to set up the scenario now. Richard Holt is 62. 28 years ago, he founded Holt Precision Engineering, a specialist manufacturing supplying the aerospace and automotive supply chains. Today, it turns over £14 million with EBITDA of £2.3 million. Richard thinks the business is worth £20 million. He owns 100% of the shares through a holding structure that has never really been tidied up since a reorganisation in early 2000s. His two children are both in the business. Tom, 29, runs operations and has been there 8 years. Sophie, 27, runs client relations and she is 3 years in. Richard hasn't actually asked either of them whether they want to be part of the business going forward. And right now, there are two live approaches on the table. A mid-market private equity house wanting to use Holt as a platform to roll up smaller precision manufacturers, and a trade buyer, a larger listed engineering group, wanting an outright acquisition for capacity and customer access. Both have come in below Richard's £20 million expected valuation. So, Chris and Tom, before we get into the details, is this a kind of client that you'd often be dealing with? How much are you seeing this kind of client coming to you at the moment?
There's an awful lot of this going on at the moment. Obviously we're in slightly difficult economic times, I would say. I think there's a fair bit of uncertainty in lots of different respects at the moment, but the M&A market is still relatively strong in our experience, particularly with private equity, because they've still got a lot of money to spend effectively. But even if it's not these two particular scenarios, if it's like a third party purchase, I would say there's a lot of people probably triggered from all the tax changes that we've had over the last couple of years looking at succession. And so this is absolutely something that we look at a lot at the moment, but it's also things like selling to management teams, maybe. So might be selling to management, might be selling to family, even employee ownership trusts and so on. So there's lots of different things that people think about in terms of how do I pass on this business to somebody else? How do I exit?
Thank you. And Tom, are you seeing business owners in their 60s looking at cashing out, or the great wealth transfer that we hear a lot of?
Absolutely. Hopefully we've known this client throughout his business journey. So whether it's his ISAs, his pension, he's building up wealth along the way. But this moment is exactly what we tend to see. And 62, mid-60s, he's probably got quite a long time left to go, but he wants to start thinking about it, passing it on to the next generation. How are you going to get them involved? Are they interested? Clearly, in this case, actually, they're working in the business, so that adds probably a little bit of a family dynamic to it, and helping clients through that sort of process. And then what they do with it afterwards is exactly what we're doing, yeah.
Fantastic. And Chris, so just looking at some of the pre-sale tax planning, what are some of the headlines? What are the things Richard should be considering?
I mean, it's almost taking a step back, similar to what you were saying. Hopefully you're talking to these sort of situations and individuals a lot earlier than maybe the scenario you find yourself exactly in now. It's not impossible.
With an offer on the table,
yeah, exactly.
The prep needs to go ahead.
I mean, quite often, yes, you've got these two offers. Somebody's offered you potentially a bag of cash, and it's obviously encouraging for them to potentially look at it. But as I said, there's lots of different ways that you can structure a transaction and lots of different options for succession. So, greatest respect to the two of us, potentially, like you might actually want to speak to somebody else, like a really strong corporate finance advisor, to really assess what are the different options here, what does it mean for you and your family, and what are you looking for as a starting point. And that can sometimes happen 3-5 years out in terms of planning for potential exit, and whether that is a PE transaction, a trade sale, or some sort of internal succession or part exit, if you like. So it all kind of is governed by what sort of exit you want in terms of the pre-sale planning that you might do from a tax perspective, but often it's trying to get the business in the right structure for a transaction, and that's guided by a number of factors. So it depends on what your priorities are and what actually is in play at the time as well. So at the moment, we've got an awful lot of speculation around capital gains tax rates and whether they're going to go up. And so the thing that is guiding a lot of the conversations at the moment is, okay, well, what do I need to do? Is there anything that I can do to sort of give myself as much flexibility should things change in the future? Because if it was a, say, 45% CGT rate, people might not want to do the transaction, whereas at 24, people will continue doing it. So there's a bit of that in terms of understanding what your options are, and is there anything that in the future, if you've got a deal in the future, how might it be structured to ensure that it can go ahead? Then there's things like, okay, well, do I want to pass anything on to the next generation? And do I need all of these sale proceeds? And there's a bit of a cash flow management exercise to understand what you need and what you want for the future. It's quite awkward sometimes. You come in as a tax advisor and you're saying to somebody, you haven't even seen the colour of the money, and you're going, well, actually, no, what you need to think about is giving some of this away before you've even seen it. So a lot of our planning, I think there's only really one key thing from a tax perspective that you absolutely do need to think about, and that's whether you want to use a trust or not. And that's because you have, prior to a sale, potentially benefiting from something called business property relief, which is inheritance tax, and it means that you can fund a family trust much more tax effectively prior to a sale than you would be if you wanted to fund a family trust with cash. But I think the vast majority of the other things, it's sort of responding to what the landscape is at the time. And
that trust could be a very useful succession planning vehicle, isn't it? You'd work in concert with other advisors to kind of set that up and put that in place.
That's right.
And Tom, on the pre-sale proceeds and the amount of wealth that Richard has already created in his companies, we know he's running a profitable company over a long time. As you mentioned on the top, he's probably got ISAs, pensions, other savings. So how would you manage money for an active entrepreneur like this? He hasn't had his big exit, but he's got funds there. He doesn't know what's going to happen in the future. How would you kind of start approaching that and get to know him that way?
And we see this a lot. And at Richard's stage, he's done it for 30 years plus, probably. He's built up probably some pretty decent assets if he's saved wisely. Both he and his spouse, I assume he might have one, ISAs, pensions, just general savings, should have been building up at least with his retirement in mind, in case the business was not ever sold. So hopefully he's thinking of that constantly and building up for his retirement. So that's a useful starting point. What we sometimes see though is for younger entrepreneurs who get in this exit stage, they are often looking for a reinvestment into something else pretty quickly. Richard probably isn't. I think he's probably thinking about the beach, hopefully.
Yeah.
And so
all his funds aren't going to be tied up into the next deal.
No.
Yeah.
So, but for those that are looking to roll into the next deal, you get the first exit, and the same for Richard. Hopefully, along that journey, it's diversification from his big illiquid asset. Whether it's all UK, so that means global investment, other asset classes, just spreading his risk, probably not taking that much risk. Typically, if you're all of your wealth or a large proportion of your wealth is tied up in one illiquid specific industry, very, very cyclical industry as well. So hopefully you've planned for that, and what he's got aside from the business is well diversified, providing him with sort of long-term growth, but without risking both pots being eroded at a moment of market turmoil.
Thank you. And Chris, with the 2 adult children in the business, I mean, we say in the notes that it hadn't really occurred to him or tabled it with them. They're both in their 20s, so they're still quite young in their careers. But what's the importance of tabling conversations with those, particularly actually embedded in the business, about because that can affect.
Yeah, well, obviously it's key to their futures, and they're one of them is relatively new into the business, and but the other one I think has been there close to a decade. So. Yeah, that can be quite a difficult conversation, because it depends what their expectations were and what their hopes and dreams are. If you like, do they see this as something that they were potentially hoping would be passed down to them? That's obviously something. If suddenly that is the rug is pulled underneath them, that's a difficult conversation for Richard to have. If it's a private equity transaction, would they form part of potentially the management team going forward and be incentivised that way? If it's a trade sale, maybe they're part of a handover period. What would it needs some thinking about what their role would be as part of these transactions. So, it's important. It's almost a more family dynamic situation that you need to manage, and that's again why I think having those conversations much earlier rather than just presenting, right, suddenly your life is completely changing and turning on a pinhead. It's important to think about these as far out as possible and have those conversations early on.
And on the valuation, obviously an important part of the deal, how much this company is worth. I know you work with colleagues who specialise in this. What kind of role might they play in the negotiation around, once you've found the right structure, actually what's the value of the asset? We note it's below Richard's expectations, which I'm sure is common.
Yeah, so I mean there's 2 parts to this. What's important is, yes, there's the valuation of the business and potentially driving as much value for it as possible, but also, it's also driven by the personal part and somewhat what do you actually need? And some people lose focus on that. Actually, you don't necessarily need that extra 2-4 million, whatever it might be. If actually you do that exercise and looking what you actually need for retirement, what would to live that lifestyle, to live on the beach, as you were saying. Your current offer might be the right one, and then are you potentially turning down a bird in the hand for something that might be turning in the future, but you're leaving things at risk then, aren't you? Will a deal happen in the future? What will happen to the economy? What will the tax rates look like and the tax environment more generally? So you could actually end up much worse off by delaying things rather than just actually assessing what do you actually want and need in your life. So yes, again, that's where corporate finance advisors earn their keep, if you like, aren't they? In terms of assessing, helping people through a transaction. There are plenty of founders who will think, I can do this. Obviously they've got to where they are by having that sort of approach and entrepreneurial spirit. But a corporate finance advisor worth their salt will obviously be able to help drive the value up.
And Tom, might you put together indicative portfolios that would show kind of how income could be derived from certain different
sooner the better,
yeah,
as Chris says. So we can help plan for what you might need. What kind of lifestyle are you looking for? Are you planning to spend any of the capital initially? I'm assuming that he owns his own house. He might want another one. Do his children have houses? Is that a way of advancing some of the capital proceeds out? So yeah, planning early, seeing what they need, and then if we all knew how long we were going to live for, these kind of things would be quite easy. But sadly, we never know. So you've got to plan for that for as long as you possibly can.
And in all likelihood, he's got a long life ahead of him, hasn't he? And
I hope so. Could easily have 30 plus years if he's lucky. And then we always have to plan for care costs. Which are can be very, very expensive at a late stage in life, or at any stage. But we have to plan for that, and that often comes into our gifting discussions with clients.
But also the inflationary environment at the moment is making people think, isn't it? How long will assets last? We're not in a low inflationary environment anymore. We're in a much more difficult environment.
That's enemy number one. Yeah, really is. The capital value today has got to last. If it's going to last 30 plus years, inflation's the biggest enemy. So you've got to take a degree of risk to protect that against inflation. But yes, certainly planning way out into the future. We don't know what's going to happen, but we can make some sensible assumptions.
And Chris, just sort of moving through, looking at post-sale, what the future might look like from a tax perspective. So the 2 deals that are on the table that Richard are looking at, the PE route where rolling over a minority stake, 3 to 5 year earnout dependent on targets, is available, but also the trade sales, more of a cleaner exit, but perhaps less upside. How might you look at the tax aspects of these different deals?
Yeah, there are quite a few things to unpack there, and some of it again is informed by what's going on a macro level in terms of tax and the economy. And as I said, the speculation of, say, CGT rates going up, potentially exit charges if you leave the UK, and somebody in Richard's circumstances, I would say I've never been more busy in terms of having conversations, at least, about people emigrating as part of that, maybe pre-sale as well. It's always been a factor, I would say, that people undertaking a large transaction have thought about it, but until recently, I don't think that many people, as a percentage of the people doing transactions, actually acted upon it, because it's such a life-changing event. And somebody in richer circumstances, if they are thinking of that, place in the sun, if you like, actually emigration is something that is more likely to be on their agenda. And I've never had more conversations about it, frankly.
But there's lots of traps there and ways they can get that wrong, aren't there?
Absolutely, yeah.
Bringing other jurisdictions in play.
Absolutely. So it's got to be driven by lifestyle as well. Like, you've got to generally choose somewhere where you're happy to stay out of the country, because you've got to stay out of the country for at least 5 years. So if you don't do that, lots of traps. If you do things wrong, you're obviously going to get a lot of HMRC scrutiny if you go down this route as well. But we live in a very different world to where we were pre-COVID, and actually, for somebody doing a trade sale, it's a clean exit. It's not actually that difficult to achieve if you have that in your mindset, that actually, I do want to live in the Algarve or something like that. Not that the Algarve is necessarily a great place to sell your business, if I'm being honest. But there are destinations that it might be effective, and then you assess your life and you decide, right, actually, maybe I'll go here to start with as I'm determining where I want to choose. And that historically in recent years has been places like Dubai, as almost like a stepping stone to decide then where would you actually want to end up and set up. But again, it depends on your own personal circumstances and so on. So that is a factor. I think in a PE type transaction, pretty challenging, because obviously they usually want you to stay in the business. Can you do that remotely? Some businesses you can. Like tech businesses, if it's pretty remote and you've got a remote workforce, it's possible. Much harder if I'm living in Yorkshire, I live in Leeds, manufacturing widgets or steel manufacture or something. You can't really do that from a beach somewhere.
And rules around working in the UK are very precise, aren't they? And very easy to fall foul of. Yeah.
So agreed. And so it's not appropriate for everyone and every type of transaction. But if somebody is looking at a full exit, I would expect someone like Richard, it might be on their agenda. If we assume that he isn't going to do that, because I always think that is sort of break glass in case of emergency type planning. It's not for everybody. It definitely isn't appropriate for everybody. The vast majority of people want to stay in the UK and they want to pay, and they're quite happy paying a fair amount of tax. The problem is that the tax burden has got to a level that it is encouraging potentially some people to explore moving overseas that they might otherwise not have done. But assuming that he wants to remain in UK, he's got children in their 20s, maybe grandchildren in the future. You were talking about care and so on earlier. That's a factor that can bring people back into the UK as well.
It's probably young enough to perhaps have parents as well.
Yeah, absolutely.
Which is often big.
So lots of ties potentially that want to keep somebody here. Now, with a trade sale, can be relatively straightforward. Most of your proceeds hopefully are paid up front. There may be a little bit deferred, depending on performance. But the main thing that people generally concerned about in a transaction like this is what is going to be the tax rate payable? How much tax am I ultimately going to be paying on this deal? And what tax rules are going to apply? Will it be capital gains tax? Will any of it be treated as income, for say like employment income, for example? And if it's all paid up front, generally speaking, it's a relatively straightforward process and it's going to be taxable to capital gains. With a private equity type transaction, quite often you get a proportion of your proceeds payable in the future dependent on performance of that business, known as an earn-out. And then there's a question mark as to, okay, well, do I want to pay the tax on that up front? Depends on how the earn-out is structured. So even though it might be payable in 3 years' time, say, it's possible in some circumstances to be able to structure that earn-out so it's taxable up front when you've got certainty of what the tax rates will be. But obviously you're paying a tax bill potentially much sooner than you might otherwise be. Alternatively, if it's in another type of earn-out, it's payable and taxable when it's paid. So whatever the tax rate might be at that time. But you're paying the tax bill later. So there's a little bit of understanding, it's almost rolling the dice. What risk are you willing to take on all of this? You can often, if you end up paying tax up front and you don't end up receiving the earn-out, you can usually claim that back without any problems. It's a bit of it's administrative hassle, if you like, but that's not an issue in terms of leaving yourself out of pocket in the vast majority of deals. But there is that toss-up. Do I want to choose to accelerate a tax charge, but for certainty on the tax rate, or defer it and actually, only pay the tax when it's actually due?
And with the broader backdrop being that the CGT rate at the moment feels lower and could go higher, so that's also it's not like a fixed rate,
No.
It's not
Agreed.
fixed out into the future, is it?
Look, we've already had one CGT rise within this current government, and there are a lot of things that are probably that the new parliament, if you like, under new is existing parliament, isn't it? But under new leadership, there are a lot of things that they want to do. That costs money. You're going to have to raise additional revenues probably in order to fund some of that, as we found out with things like defence funding and a hobby. One of the key areas that Andy Burnham is passionate about is social care, for example. So how would you fund something like that? That's quite an expensive thing to fund. There's going to be probably more taxes on wealth, not a wealth tax, but the obvious targets would be looking at inheritance tax, looking at capital gains tax again. And then you're into, actually, will this raise that much revenue? Because it drives behaviour so much for these smaller taxes. Because if you had a 45% CGT rate, which is what's being mooted by some, particularly within both externally by economists and various groups within the Labour Party themselves. I'm not saying this is Andy Burnham policy by any stretch. I think it's very much something that's being looked at, being probably mooted to him. But it is something which seems to be growing in consensus amongst various MPs and economists that actually we do need to look at CGT reform from a number of different aspects. And the likelihood is that we would have a more closely aligned capital gains tax rate to income tax rates. And if that happens, it's probably going to come alongside some sort of inflation allowance. So it's like everything, like things seem to come back in fashion, don't they? Apparently flares are back in fashion. I'm way out of date on this. But a lot of the tax rules that I started when 20 years ago, indexation allowance, just that would come back in. It would have a higher CGT rate, but with some relief for inflation. That's not going to necessarily benefit somebody like Richard. If he founded this business and he's got, £1,000 worth of initial share capital, you can index that up as much as you like, but if you're selling for 20 million, you're not, that inflated in £1,000 isn't going to go very far. So the burden potentially of a higher CGT rate is going to fall more on people like Richard, and that's why it's such an important topic for them at the moment, particularly if they've got a transaction in the next 3 years or so.
And if they had looked at using a trust to own the shares, when the proceeds come through, that's obviously be subject to the trust kind of tax rules.
Yes.
I mean, without getting into the weeds, how would that affect
You've got a choice.
position?
Yeah, you've got a choice. So often there's a balance here, because often people don't necessarily want to put things into trust too soon. They'd like to ideally put it in when there's a bit more certainty that a deal is going to happen. It's not giving it away when otherwise they might not have otherwise chosen to do that. So if you gift into trust, you can usually defer that liability from a capital gains tax perspective. So you can enter into an election with the trustees to defer that, so the trustees pay any capital gains tax when they eventually sell the shares. Or you can choose to, that's a disposal, you can choose to pay it yourself. And so the trust receives effectively an uplifted market value of share when it comes to sell. It's only if the shares have grown in value from the date of that gift that it would be subject to capital gains tax. So there's two ways of structuring it. Vast majority of people usually go down the holdover relief route, which is deferring that liability, and then the trustees paying it. So it's a bit of working alongside investment advisors and so on, going, okay, what do we want the net pot in the trust to look like? And how do we get there? What's the easiest route of getting there?
And Tom, then if there is a trust and it's funded with substantial proceeds, very long-term money, the broader conversations around succession planning, how do you kind of do your job in that context?
Way we typically find it works best, especially when someone perhaps is receiving a lump for the first time, is to help them think about it in terms of different pots of risk profile, pocket things for different purposes. So typically you want a reserve for whatever expenditure you're going to need for the next, 3 years, say. And you can keep that short-dated, safe, return of your money rather than the return on, but try and, get a decent return at least. Short-dated gilts today aren't too bad. The government might make them more expensive. We don't know, but it's not a bad moment to just have a cash reserve. Then you can think about, okay, well, we're going to need to draw some income. We're going to need to spend something over that 3 to 5 year sort of period, and we can take a bit more risk with that, and they can see that how that would flow into the short term, and it's just slightly a reserve. And then there's probably quite a large chunk for Richard and his family that he's going to pass on. He's not likely to need in his lifetime, and really that can have a longer term time horizon, and that is where you can go for growth, probably full equity exposure, and you can still receive the income from it, but ideally you're looking to reinvest the income and let it compound for his children, grandchildren, and set up a multi-generational sort of opportunity for his family.
Because an all-equity mandate people might perceive as risky, and obviously it is, but with that time horizon, you're able to offset that in a sense.
Definitely, and I think if you've got, we would typically say you've got to have more than 7 years time horizon for, starting point can make a big difference. Today, who knows? We've had a good few years in equity markets. Potentially things feel quite exciting, but it could run for a lot longer. So, regardless of when you make your start, you really need to be thinking 7-10 years plus for full equity.
Presumably you kind of drip feed into the market. So like you say, you're so uncertain as to where we're at,
timing,
and if you're getting started.
Exactly. If you're getting a lump today, putting it all in on day one may, in hindsight, turn out to be the best decision. You just don't know. Terrible. So typically we would advise someone to make a start, maybe 20, 25%, just because that first one is often the hardest one to commit to, and then phase it in over a period that feels sensible. It could be 3 months, 6 months, as long as 12 months, either on a fixed date, or you can accelerate it, reverse it, depending on what happens in markets as you go. Someone called it regret management to me once, which I sympathise with. It is, and from an investment manager's perspective, it is certainly a sort of cautious way of doing it, but you just don't know if it's going to be a good moment or a bad moment. Over 10, 15, 20-year time horizon, it should all wash out, but certainly a phased approach is what I'd typically recommend.
Presumably, particularly in this sort of market, because it's been so volatile over the last couple of years, hasn't it? And it's time in the market ultimately, as they say, isn't it? Rather than timing the market.
The biggest equity market dynamic over the last 2 or 3 years, maybe actually even stretching back to COVID, if you remember, is the recoveries after sharp sell-offs have been pretty much V-shaped. So we haven't had, 2022 was quite a sort of prolonged drawdown, but COVID, Russia, Ukraine even, Liberation Day last year, and the war in Iran this year, pretty much back to where you were, at least within 3 months. So those are opportunities.
Yeah.
And in terms of the pots and how Richard spends, I mean, Chris, we've seen tax reforms coming in 2027 around pensions and inheritance tax.
Yes.
Previously, someone like Richard, if they had a pension, they might have saved it over because of the efficiencies of it, but now they might decide to spend it down. Give us a sense of what's happening, changed in the pensions world that would affect someone like this.
Yes, well, we've had lots of inheritance tax changes already come in. Some of that is in relation to shares that Richard owns in the business with business property relief, and just it might be helpful for listeners that a lot of people still assume that all of those changes just apply to farmers. We've obviously seen outraged farmers in the streets of London with their flaming pitchforks, but it does also apply to business owners, and I still regularly meet people who are completely unaware of that fact. It's so much media attention on the farmers' cases, but those rules do apply to business owners as well. So somebody might assume they don't have any inheritance tax in relation to the shares in their business. They now do, and it has applied like that from 6th of April 2026. But the other big change, like you were talking about, is something that hasn't actually come in yet, which is from 6th of April next year, 2027, we will have inheritance tax on pension pots. And that basically, it completely changes people's strategies. And this is one of the reasons why they are changing, in fact, the rules in this way. It's because people have been effectively using pension pots as trust funds to some extent. You've got potentially people with very large pension pots, and the strategy has, as you likely say to anybody with some sort of financial acumen would probably say, you don't want to touch that. If it's not going to be subject to inheritance tax, why would you draw on it? So if you could pass it down to the next generation almost tax-free, then just leave it. That would be the last thing you touch. Now it's almost completely flipped on its head, and now you've got the potential, if you were to pass away over the age of 75, of your beneficiaries of that pension pot, if you like, your children often, will be subject to income tax on that, and there will also be inheritance tax to pay. So awful lot of complexity to it. So it's really that double whammy of income tax and inheritance tax on that part, which has brought it to the front of the queue again, and means, well, actually, rather than deferring it, use it for what it was originally set up for, which is as a pension. And so if you need an income in retirement, that's probably the most sensible thing to look at first.
And I suppose the sale and being post-sale, it would naturally draw up lots of conversations around succession plan. Once the dust has settled around the transaction, if they had the cash proceeds in their personal name or in a trust, they need a plan around what their inheritance tax exposure is and what their longer term game plan is.
And obviously inheritance tax it's very emotive. So to some extent, you end up with people on a spectrum of where they sit on this. Some people absolutely hate it, want to do as much as they possibly can to mitigate it. Then you've got some people at the other end going, well, I won't be here. And frankly, it's still a fairly big percentage that you're going to inherit of a big number. So we weren't going to do anything. Most people often sit somewhere in the middle, accepting that there's going to be some inheritance tax to pay, but if there's things sensible that we can do to mitigate that during our lifetime without pushing the envelope too far, then they'll explore that. Now, with inheritance tax planning, I think fundamentally it comes back to what are you prepared to give away? And that's probably the biggest challenge, I think, is going through that exercise and mentally detaching yourself. I don't actually need that. And that's where the advice, I think, can come in, particularly on the financial side of understanding what you need and want. You can never fully predict it, but there's various tools and models that you can run to help manage and map out, if you like, what somebody's cash flow requirements are over their lifetime. That's a useful starting point. But then you've got different points. You've understood, okay, this is how much I need to keep at least. How do I make that gift? Who do I make it to, and when? Those are the next questions. And that's, particularly with children in their 20s, you've got various different factors that come into play. Do you want to make a gift to them directly when they're just starting out in their careers? What would that do to their own ambitions and potential drive to become an entrepreneur in their own right, for example? Is it too much too soon, effectively? There's the risk of things falling outside of the family estate, through divorce and things like that. And then you as a parent, are you having awkward conversations with your children about pre or post-nuptial agreements? They're maybe not as awkward as they used to be. They're much more common. People seem to be more accepting of them now. But it's still, I'm not sure as a parent I would want to be in that seat necessarily broaching that subject. So it's a number of different factors that then come into play. And that's when you can make a gift directly, but there are different ways and means. That's why family trust often sits in the mix, and that's why we look at that, because it's easier to fund them pre-sale than it is post-sale, because there's pretty hefty upfront tax costs for funding a trust after a sale if it's just with cash. But you've got other vehicles as well. So the main alternative would be a family investment company, for example. And a lot of clients actually prefer to just sit, pause, let the money even just sit in something fairly straightforward, like a national savings account or something. Just let the dust settle, as you said. And then after a year or so, right, now we're going to look at what the planning is with having got rid of the business. There's a different problem to address. Sometimes people think, I've sold my business, I've got rid of all my problems. Actually, you've got a whole new set of them that you need to consider.
And if there was a trust in play, there are ongoing tax charges on that trust, and then there's tax implications on distributions. Just give us a rough sense of what that people would think about around that.
So, one of the benefits of a family trust is that it doesn't sit in any one person's estate. Once you make a gift, once you've survived that gift by 7 years, it's usually outside of your estate for inheritance tax purposes. And a family trust allows you to effectively control that pot with a different hat on, a bit like being a director of a company. You've got duties that you need to maintain the trust pot. But it's not for your benefit, typically. It's usually not effective if the people that actually set up the trust also benefit from it, from an inheritance tax perspective. So often you'll have trustees, which might be parents, for example, maybe some of the children as well, maybe professional advisors. But their job is to maintain, look after the pot, if you like, sat within the trust. But they've generally got full discretion as it's often they're discretionary trusts is what the formal title for them is. So it does what it says on the tin somewhat. It's a bit Ronseal. You've got full discretion as to what you do with those funds within the trust, and when you apply them for the benefit of the beneficiaries, which are typically the children, grandchildren. It can just be really broadly defined, so your lineal descendants, for example, including things like charities. So that pot has various tax implications for that benefit. It doesn't sit in any one person's inheritance tax estate, so it's not exposed to 40% if it's within that trust pot and you've survived the gift. But that obviously comes at a price. So it's not yet, there's a quid pro quo here. And the main one is that every 10 years, there's an anniversary charge of up to 6% on the value of the assets of the trust at that time. There can also be a pro rata sort of charge on distributing capital out of that trust. So let's say it was you wanted to wind it up after 5 years. You'd pay half of that because half of the 10-year period has passed, so basically a 3% charge. And there are various ways and means of mitigating that, so investing into tax-effective investments, for example, for inheritance tax purposes. But that's broadly one way of looking about it. It's for the privilege of not having it within any one person's estate. It's a bit like I've got a 0.6 IHT charge accruing each year, and I've got to beat that plus inflation to maintain your pot.
Which we can plan for. Yeah. There's relative certainty that that's what it's going to be. So over a 10-year period, you can start to plan for that as you go. So that's one of the conversations you have.
And Tom, I mean, if, say, Richard decided to make straight gifts to adult children and assuming they've got the flat or the property that they want and there's some left over to invest, do you start, given these are young people who might not have managed investments before alongside an investment manager, what kind of process do you go through with younger clients to get them up to speed on how you can get your money to work?
Yeah, I'm sure Chris is exactly the same. We spend a lot of time on education, really, and actually sitting down with clients, helping them, especially where they've been in a business, doing something completely different. Often it's completely alien to them, and they haven't operated also in the listed world. One of the biggest adjustments is going from having maybe a valuation on your business every 3 years, say, to having a daily valuation where you can look it up on an app and see whether it's gone up or down. And that is quite a different feeling for clients.
It can create unnecessary anxiety in a sense because you've got to set your roadmap.
Well, often it means clients start out more cautious than they need to do. And just as you said, Chris, with the sort of year to set things out, often we'll see clients start relatively cautiously. As they get more comfortable with market fluctuations and not looking every day at their valuation, then they typically get more comfortable and you can start to build up risk exposure over time for them. But with the next generation, including them as early as possible in the conversations, and our families do it differently, but typically the best we've seen is where at this age, 27, 26, it's a great time to start being made aware of family wealth and how it's managed, who the trusted advisors are, sitting in on meetings, and having separate meetings with them if parents are happy or the trustees are happy for them to do so they can ask those questions that they might not ask at a big family meeting because they're too scared to ask, etc. I think family foundation type arrangements are actually a very good way of introducing families or younger generations into family wealth. It's not theirs, they're there to give it away. They can come with their own ideas about how they want it to be given and distributed, but they still want to monitor the investments. That sort of thing is a very good introduction. Yeah,
that is something that we're seeing much more interest in, actually, sort of philanthropy. And post-deal, ordinarily you've got quite a large tax bill to pay. So if you are looking at maybe setting up your own charitable foundation or donor-advised funds, that sort of thing, it's a good period immediately post-sale to start exploring that, because actually you can benefit from gift aid on the contribution into those within if you undertake it within a certain period of time post-deal. So you're not just you as an individual benefiting in terms of the the tax relief that you might receive, but also the charity will be able to benefit from that uplift from the government in terms of the gift aid that it's able to reclaim. So, again, it's exactly to your point, introducing other family members into sort of the world of your wealth, if you like, the family wealth, using a a pot set aside for charitable purposes is a really good way of introducing them to that.
The one thing I sort of always quite nervous about is clients over gifting, because we just don't know how much you're going to need and how long you're going to live for and what life is going to be like. At 62, you've got a long way to go. So, I think lots of clients in this situation get very itchy about doing a lot quickly.
Yes.
Because of the 7-year clock, and maybe it goes to 10, or whatever the rate changes or whatever it might be. But actually, you've got quite a bit of time probably at 62, and doing it on a sort of phased basis over time. If they've already been given houses and things like that, they're not even had children yet, so maybe education costs start coming into it in 10, 15 years time. You can start thinking about it then, so that by the end, or when you're into your late 70s, say, in 10, 15 years time, you look back, you've actually done an awful lot. And that's where you get clients you mentioned, Chris, who are not on that end of the scale where but they're in the middle somewhere where they look at it and they go, well, actually, I've done a lot of planning.
Yeah.
I've actually given a lot to the next generation already. If I were to die today, the bill would be X. It's still probably a lot of money, but I've done a lot. So
I guess that's where the trust gives you a lot of optionality, doesn't it? It gives you a structure and a vehicle that can be very long term and don't need to make decisions, but you are doing something. It's not just cash sat in your bank.
Yeah.
Crucially, the trustees retain control.
Yes.
So I think one of the dangers of gifting things too quickly to the next generation is they're probably going to use it for something, and there's no guarantee that they are going to pay it back to you for your care, or there's no guarantee that they're going to look after you.
Yeah.
So you've got to keep enough back for yourself.
Thank you very much for talking to me today, gentlemen. If you were going to see Richard next week, you're going to be on the phone with him. What are the headlines? We talked about an awful lot there, but
yes.
what would you be tabling with him as these are some of the things you to think about, and these are some of the things we'd like more info on to kind of get to the nub of how we can advise you.
So I think the starting point is often laying out what people want to understand, what the likely changes are going to be over the next 2-3 years, potentially from a tax perspective, so they can plan ahead accordingly for that. It depends on how quickly this deal is going to happen. So often my conversation, I feel like I'm scaremongering people and being a bit of a doom monger, but actually what you're trying to do is make sure people aren't panicking. And we've talked about it a lot so far in terms of you can make a lot of decisions driven by potential tax implications. And as we've seen over the last 2 years, the world of the tax environment can change enormously in a very short space of time. A next government might have a very different view on taxes on wealth than the current one, for example. So it's important not to rush into structuring and doing all of this. It's try to take a long-term balanced approach, similar to what you were talking about in terms of investment. And I think that drives also people making decision-making on whether to sell their businesses as well. We see it with people selling, up and down in the markets, panic from the volatility. The same thing happens with, is the economy, in a bad shape? Do I need to sell now because the tax rates are going up? You can ultimately end up in a really bad position. So much worse than you might have been if you just held on for a couple of years. If this is not the right time for retirement and to sell on, then don't let the tax, is the cliche, isn't it? Don't let the tax tail wag the dog. So a lot of what we do in the start is really just, this is what we think. Let's take a step back. Let's try and take a balanced view of everything that's going on and try not to have a plan which is too front-loaded, if you like, and responding to the stories of the day, but actually what are your underlying objectives and how can we help you get there?
Thanks. And Tom, what things would you table with him?
I would just say get advice as early as you possibly can from the right people, get the right people in the mix, and then start thinking about potential structures afterwards, making sure you're not going to do something that reduces your flexibility going forward. So I think at this stage you want to get maximum flexibility, because if the rules change, you don't want to find yourself going down the wrong rabbit hole. Work out what you're going to need to live off. It's kind of the crucial thing that we'd be asking right now. If you get this pot, what does this mean? Does this mean a big change in your lifestyle? Are you going to, travel the world and spend lots of money, or actually just going to continue actually going about your sort of day-to-day life? And then we can start planning for that. Don't know how long anyone's going to live for, but we can start planning about that, structures, as I said, and then those next generational gifts, bringing them into the conversations, and we haven't talked about, he's going to have to sit down and have quite a difficult conversation with his children who may or may not continue to work in this business afterwards. So they might need some support one way or the other.
Yeah.
Well, thanks for talking to me today, gentlemen, and we look forward to sharing this case study.
Thanks a lot.
Thanks
David.
very much. Thanks, David.